Okay, and welcome students who are taking financial accounting, and in this series of videos we are working on the theory for the chapter 4, accounting for merchandise business. This series of videos is not going to take that long, maybe 2 or 3 videos at the most. And as always, if you don't understand something, watch, pause, rewind the video, watch it again, and if you still don't understand something, then telephone and speak with an instructor. Okay, so I'm just going to get right into it. Chapter 4 there's not that much to cover in this particular chapter. I mean, there is, but I don't have a lot as far as theory to cover, and you'll see that I'm going to be referencing something else. But anyway, so one of the concepts that is covered in this chapter is the idea behind periodic versus perpetual inventory. Most businesses use periodic. Okay, perpetual inventory basically means that it's an ongoing inventory. As you make changes to it, you're constantly updating your inventory. So let's say you have item A, you have 10 of item A at $10, so that's $100, right? And you have, you buy then 20 of item B at $5, so now that's $100. So now your balance is $200. Okay. Now notice what happened. When I started out with 10, or I bought 10, my inventory value was 100. As soon as I bought 20 more of something else, my inventory changed. So now I have a new running balance of 200. Now let's say I sell 2 of A, right? So I sell 2 of A, and that's at $10. Okay, so that's $20. Well, since I'm selling them, now my new inventory value is 180. So what I'm doing is I'm keeping track every time something goes into inventory and something comes out. If I buy, say, 5 of C at, let's say, $5, that's an additional 25. So now my new inventory value is 225. You see how as things go in and out, I'm constantly updating the value of the inventory. That's perpetual inventory. It's not very difficult. All you're doing is just keeping track of what's going in, what's going out, and constantly updating the balances. Now, periodic inventory, though, is a little bit different. Periodic inventory, as you can see here by the formula that was in the book, you start out with a beginning inventory, and then you add all of your purchases, which gives you a cost of goods available for sale, right? So if I started out with a beginning inventory of, let's say, $1,000, okay, I don't care what that is made up of. All I know is that my inventory value was $1,000. If I, during the course of an accounting period, now generally this is, goes by accounting period. So at the beginning of the accounting period, I start out with $1,000. Now let's say at some date, right, I buy $250 more. And then on another date, I buy, say, $150 more. And then on another date, I buy, let's say, $300 more. Okay. At the end of the accounting period, all right, my books, okay, so my books will show that I have $1,700 at the end of the accounting period. Now here's the way you think about this. You have your books over here, and you have your physical inventory over here. Meaning this is what's physical is what you've actually bought, the item itself. But what you keep on your books of accounting, it can be different from the physical inventory. For the simple reason, when you're doing the periodic inventory, like in this case here, as you add, your books keep going up, okay? but your physical inventory doesn't necessarily mean that there's $1,700 in there. I mean, think about it. Let's take the example of gallons of milk in a walk-in cooler. Maybe you start it with, say, 25 gallons in the cooler, right? There's 25 gallons in the cooler. And let me do it like this. Let's say there's 25 gallons in the cooler, right? And that means you have 25 gallons on your books. Okay, it doesn't matter what the value is, but remember, you're in an accounting office, and in the grocery store, there's a manager and there's people buying and milk, and maybe a carton gets broken, something gets stolen, whatever. So what's physically in the cooler changes from what's on your books, and the manager might buy 25 more gallons, and let's say buys 25 more, and he buys 20, he orders 25 more. So on your books, your books show you have 100 gallons on there, okay? But physically, there's not 100 gallons in there, okay? And so what ends up happening is at the end of the accounting period, you have to do a physical inventory. In other words, you go out and count how many is actually, the quantity on hand. And let's say there's 35 gallons in there, okay? Well, and that means you have to adjust your books to 35 gallons. If you had 100 and you only have 35, that means you have to adjust your books for the 65 that have been sold, missing, whatever have you. And that means the 65 has to be taken out of inventory and put into cost of goods sold. Okay, so a journal entry needs to be made for that, and that's the difference between the periodic and the perpetual inventory system. Periodic, you don't have an accurate count until you actually do a physical inventory. Okay, whereas with the perpetual, you always have an accurate account. But why would you use one and not the other? Well, I mean, if you're looking at things like automobiles, right, where you can actually, let's say you have a car lot that has 100 cars on it, you're going to want to use a perpetual inventory system because when you buy 2 new cars and you sell a car, okay? So it's easy to keep track of your inventory, and you would use a perpetual inventory system. But if you're keeping track of things like groceries in the grocery store, items like Walmart, things like this, M&Ms, whatever, even let's say parts for a plumber, or he's got fittings and bushings and valves and all kind of other stuff. Well, it's difficult to keep track of your inventory if you're constantly, um, you know, he buys a package that has 10 items in it, and he only takes out 2 of them, okay? And he throws the rest in the truck, and then he has to buy others, and so it's a little bit difficult to keep track. So it's better just to do a physical inventory at the end of the accounting period to see how much is in there, see what the value of the inventory is, and then you adjust it accordingly. So you have to make a journal entry, to cost of goods sold. And since you put this stuff originally in inventory, and that was a debit to inventory, meaning, as an example, let's say, you bought 25 of something and you pay cash for it. Well, you're going to end up crediting your cash and debiting your merchandise inventory. Okay. Well, now when you make a sale, all right, you're going to debit your cash, because you're getting cash, and you're going to credit your revenue account because you've made the sale. But notice that you haven't touched the merchandise inventory. I mean, it's the item is no longer in there. Okay. So whenever you make a sale of something that is in your inventory, you have to make a second journal entry to take it out of the merchandise inventory and put it to cost of goods sold if you're using perpetual inventory. If you're using periodic inventory, at the end of the accounting period, whatever the value of your merchandise, your physical inventory is, you take the you take the merchandise inventory, the balance that you have on your books, and let's just say that's $3,000, and say your physical inventory comes out at 1,250. Okay, that means you sold $1,750 worth of stuff. So you have to make an adjusting entry to your merchandise inventory for that amount. So obviously, since merchandise inventory, the normal balance is a debit because it is an asset account, okay, we have to do the opposite. So we're going to credit the merchandise inventory for the 1750, and then we have to debit our cost of goods sold account for the 1750. So that's the adjusting journal entry that you make when you're going to do your adjustment for the periodic or for the perpetual inventory. The difference being here is that when you're using perpetual inventory, you make the sale, you immediately have to take it, you have to make an adjustment because you're taking it out of inventory. So whenever you're using the perpetual inventory method, if you make a sale, you record the sale, and then you also have to record taking it out of inventory and putting it to cost of goods sold. But when you're using the periodic, okay, you only need to do that adjustment at the end of the accounting period when you do a physical inventory. Okay, so what I'm going to do here is I'm going to cover that again real quick. On one side, you have your physical inventory. And on the other side, you have your books. Okay. Now, if you're doing the perpetual inventory, every time something goes, you buy something into inventory, you make an adjustment to your books. And if you sell something, all right, you have to take it. If you sell something, you're going to make an adjustment to your books. Meaning, if I buy something, I'm going to debit inventory and credit cash. That's when I buy something. Okay, so that item, let's call it $1,000, goes into, I have $1,000 now on my books and have $1,000 in inventory. Let's say I buy something else. So I'm going to debit inventory, and let's say it's $2,000 this time because I'm buying two at 1,000, two at 1,000. So that's $2,000. So I'm going to credit my cash for 2,000. Now remember, we're doing perpetual here, okay? So now I have 2,000 in inventory and 2,000 more on my books. So my value of my inventory is $3,000. Okay? Now, let's say I sell one of those items. So I'm going to debit my cash and I'm going to credit revenue because I'm making the sale for $1,000. Okay? Now notice that I didn't touch inventory. Okay? My books will show that I still have 3,000, but when I sold the item, right, my physical inventory is only 2,000 now. Okay? But my books show 3,000. So in doing perpetual, since I'm constantly updating my inventory every time something goes in or out, I have to update my books. So I'm going to when I make the entry for the sale, I also have to make an entry to debit cost of goods sold and credit my inventory account for the $1,000 so that I can transfer it out of the inventory, all right, and put it over to cost of goods sold. So on my books, my inventory now is $2,000. Okay, so with perpetual inventory, every time you put something into physical inventory, you make an entry on your books. Every time you take something out, you make the entry on your books. But when you take something out, meaning you sold it, okay, you have to make two entries. One, you're going to record the sale, okay, and two, you're going to record taking it out of the physical inventory and putting it over to cost of goods sold. With the periodic, you're going to have your physical inventory and you're going to have your books. Okay, and let's say they both start out at 1,000. Okay, now as things are purchased, you're going to keep on adding it to your books. Okay, and sure, they're going to be going into the physical inventory. Okay, and your books are going to show a balance at the end of the accounting period. However, at the end of the accounting period, you don't know how much is in your physical inventory because you know you're selling, you're making your sales, so you're debiting cash and crediting your revenue account, right? But you're not making the entry to take it out of physical inventory, and nor do you want to, because if you're in a grocery store trying to make entries for every loaf of bread, gallon of milk, package of M&Ms that are sold, that's insane. Okay, that's ridiculous. It's not efficient whatsoever. So at the end of the uh, accounting period, your books will say you have $3,000 worth of stuff in there, but there's not 3,000 because things were sold, things were stolen, things went bad, broken, whatever. Okay. So now at the end of the accounting period, you actually have to go do a physical inventory. When you go do that physical inventory, let's say there's only $750 of inventory in there. That's what's on the shelves. Well, your books say there's 3,000, so you have to make an entry to adjust your books to the actual physical inventory. So that's when you make your entry to your cost of goods sold and credit your inventory account for, in this case here, $2,250. Okay, so that's how that works. Okay, it's very akin to doing, the FIFO and LIFO from the math. If you had taken math for business and finance or math applications, you were exposed to inventory methods, FIFO and LIFO. Okay, it's sort of akin to that, although it's not exactly the same. Okay, yes, you have to do you have a beginning inventory. You have your purchases, you have a cost of goods available for sale, and you have your ending inventory. But to get the ending inventory, okay, um, to get the cost, you're looking at whether you're using last in, first out, or first in, first out, or weighted average, or whatever have you, whatever you have of the inventory methods that you're going to use in order to determine what you have in inventory. Okay, but that's how that all ties in. All right. So that's it for this video right here. I'm going to stop and then pick up in the next video with discounts. Okay.